Let's go. Hump Day, also Fed Day. Happy Fed Day to all who celebrate. That's all of us. Spoiler alert. Good morning. Welcome to TheStreet's opening bell here from Post 35 on the floor of the New York Stock Exchange. Today is Wednesday, Hump Day to some. The 14th of December. It's December 14th. I had to verify. It is. I'm your host, JD Durkin. Opening bell rung moments ago here on the floor by Allison Transmission to celebrate the company's 10-year anniversary of listing. Taking a look at how the major averages are kicking off this Wednesday. Stocks are... I don't know, what are stocks doing right now? The S&P is up fractionally. They're barely moving right now. Everyone's in wait-and-see mode. Take a breath. Let's see what the dust settles. This after rising for a second straight session on Tuesday following the cooler-than-expected inflation reports. Yesterday was a weird session. Investors are eagerly awaiting the December Fed meeting where the central bank is expected to raise rates by 50 basis points in an effort to curb inflation. Like I said, it is Fed Day. Taking a look at what is on tap for this morning's broadcast here from the NYSE, we break down what to expect from the Fed as it kicks off its monthly meeting, or at least it's meeting this month. Plus, we'll talk SBF as the FTX founder faces mounting legal troubles. Lots of initials and acronyms. And finally, we dig into Delta's fourth quarter earnings as the airline shares take off. We're also taking off here on the show. Have your seatbelts in, your tray tables in upright and locked position. And let's now bring in our chief markets and senior editor, correspondent, Mr. Martin Baccardax. Martin, good morning. Happy Fed Day to you, my friend. What is the expectation today? Also, how are you feeling? Are you hydrated? Are you well rested? Electrolytes? How do you get hyped for a big day like today?
Yeah, the coiled spring, the cat ready to pounce. It's game day for us, isn't it, JD? There's no question about it. It's exciting. I mean, I'm looking forward to it. 2 o'clock announcement, 2:30 press conference. And as you can see in the early trading this morning, the rest of the world is pretty much focused on that as well. We know what we're going to get. It's going to be a 50 basis point rate hike. It's going to take the key Fed funds rate to a range of between 4 and 2.5% to 4.5%. That will be the seventh rate hike this year, but it will end that run of 4 consecutive jumbo rate hikes, the 75 basis point increases that we've seen over the past 4 meetings. Now, what is really going to be important, JD, is what's published alongside the rate decision and what will be sort of delved into detail in the press conference. And that is what is known as the dot plots. That's a fancy way of saying that it's an illustration of what all of the Fed governors see in terms of interest rate projections into next year and the following 2 years. They're presented as dots because they are reported anonymously. The Fed governors don't put their name to what the projections are. They take the midpoint of that, and we can all assume where they see collectively rates going into 2023 and beyond. Now, Fed Chairman Jerome Powell has said it's very likely that we're going to have a higher terminal Fed funds rate as a result of the inflationary pressures. But he said that prior to both the October and the November readings, which have been cooler than expected. So the market is looking for a modestly lower terminal Fed funds rate from those dot plots. And as a result, JD, if you can believe it, they're starting to tease out rate cut probability into the second half of next year.
After the November meeting last month, and then again at Brookings, if you remember the Brookings commentary he made, Jay Powell concluded his public comments both times by more or less saying the same thing. And here's the sentence that he said. And to me, it strikes like this is what he wants people to kind of keep in mind. He says, the historical record argues strongly against prematurely loosening policy, and we will stay the course until the job is done. The man has said it not once, but twice, at least recently. If we start to hear later today anything other than that very particular and specifically worded refrain, how might that be interpreted as, dare I say, a bit of a shift in approach?
Well, this is exactly what markets are looking for. So you've spotted precisely where the stress points are going to be. If he is hawkish, as I think a lot of people expect, and if he is willing to sort of push back against the market's optimism, then we could see, irrespective of what comes out of the rate decision of the dot plots, a sell-off in stocks today that could accelerate into the end of the week. However, if he is indeed in any way suggestive of a change in Fed tact and a sort of acknowledgement of the change in trajectory of inflation, then markets could absolutely wrap into a nice rally going into the end of the year and indeed maybe into 2023. Now, it's very difficult to say exactly where the balance of probabilities are poised in that respect, but I think without question, the commentary from Mr. Powell and indeed the tone of his question and answer session with the media is going to be of paramount importance today. It will be interesting to see whether he does repeat those cautious mantra with respect to not being premature and maybe looking back to last year when we were all a little bit too optimistic about the transitory nature of inflation. It remained a lot stickier than we had assumed. It's embedded into wages and it's embedded into portions of the services sector that make the Fed increasingly uncomfortable. So I don't know that we're ready to talk about pause. We're certainly not ready to talk about pivot, but there could be at least some acknowledgement of the fact that inflation is on a downward trend. And by some particular measures, we are seeing disinflation in the latter part of this year. If he acknowledges that and maybe doesn't push back against the market optimism, then we certainly could be in for a stronger performance heading into the end of December.
You know, it's funny, we talked about a pivot for so long, and I think people kind of forget what a pivot actually means. I mean, is a pivot to you an actual reversal? Because I like that we're kind of more in pause territory right now, which I think would still be optimistic for a lot of investors in the indexes. But what does a pivot actually look like? Is it at some point next year saying, okay, we've finally gone high enough and we've been there for long enough and now we start to go the other direction?
Yes, I think that's how most people would interpret it. I think to some degree there was the use of the term pivot to loosely describe a change in tone from the Fed, from significant rate hikes to maybe a slowing of the pace of those hikes, or at least a slowing of the nominal size of those hikes to such a degree that they could then look at their impact on the economy, to maybe a view of pausing when they get to the terminal rate. We're certainly understanding where the terminal rate is going to be, somewhere in that 5% region, maybe just below, maybe just a bit above. But now, JD, as you illustrated, we are looking at the potential for rate cuts into the latter part of next year. I was going through the CME Group's FedWatch this morning and trying to do some arithmetic. And essentially, it's a 50-50 chance of a rate cut in September, but actually about a 70% chance of a rate cut in November of next year. Now that, of course, is a long time from now, and there are so many things that can happen in that 11-month period. But investors right now are looking at the trajectory of inflation, which is absolutely slowing and is going to continue to do so into next year, and the fact that the bond market is signaling the chance of near-term recession. Slowing inflation and recession is just simply not an environment in which the Fed would continue to raise rates, and therefore they could be compelled to change their messaging of holding at 5% for a long time to holding at 5% for a short time, and maybe even looking at easing as a result of those pressures again into the very late portions of next year. But the fact that that is even being played out in financial markets is a big change from where we were in late August, September, and indeed really through the month of October.
You know, I listened closely to what Chair Powell had to say at the conclusion of his November meeting. I believe this next part here was from the press conference portion. He said, the pace of rate hikes is much less important. You and I have discussed this before. The pace of hikes, much less important than the destination and how long they stay there for. So to that end, how significant will the press conference component today be, which, as you and I talked about yesterday, is kind of a fascinating dance with reporters because they're really going after nuances of words. You said this. Did you mean that? Because you said this thing. Is there room for interpretation over here? It's quite the verbal science and verbal gymnastics that happens back and forth.
Yes. And I think he will need to be careful and mindful of his language today, because if he is even accidentally optimistic, the markets are going to read that as a dovish signal on rates and indeed a dovish signal on the terminal rates. And as a result, they're going to ramp stocks up very quickly. If he is overly hawkish, and again, even accidentally so, the market is probably going to retrace the modest gains that we've seen over the past few days. So it's absolutely a tightrope. I do think he will reiterate that the that the Fed funds rate, where they will reach and hold, is probably more important than the nominal increases that will take to get there. But markets are less, they're not, it's not that they're not believing it, but they don't see it as the most important component of their thinking now, because stocks are very much an indication of where the economy is expected to be in a sort of 8 to 12 to 16 month period, as opposed to a 4-month one. For the most part, stocks have already discounted what the Fed has signaled on rates going into May, and they're actually now looking well ahead of that in order to understand where value is going to be and where the value proposition for various sectors is going to lie. So therefore, what he says about that destination might be less important compared to what he is likely to say about any change in tact over the second half of the year. And that, of course, dovetails with what we've been talking about these very emergent and nascent rate cut trades, which are a long way away, but nonetheless will be embedded into stock prices sooner than you might think.
Martin, I want to take a step back and look at this through the lens of this last era of easy money, so to speak. And I don't just mean the last 2 years. I mean, kind of going back to the 08, 09 swing of things. It's amazing to me that the central bank has not raised the federal funds rate by more than a quarter point at a time in 22 years. And yet here we are today on the verge of getting 50 basis point hike, and that is going to be interpreted as a loosening of policy. Is this all just kind of relative, right? I mean, you really had to reshape. Investors had to fundamentally rethink the sort of approach to monetary policy and how they viewed it and even how they've discussed it or framed it over nearly 2 decades. And here today, the conversation's just sort of different. I wonder, just having followed the space as closely as you have for a long time, what you make of the degree that maybe is it a sign of the times, I guess, right?
I think of it, JD, in the same way that we all talk about the levels of snowfall when we were a child, right? We used to say, gosh, winters are nowhere as bad as they used to be. When I was a kid, the snow was up to here, right? Of course, you forget the fact that you were about half the size you are today. So as a result, the snow hasn't really changed. You've just gotten a lot bigger. So perspective is probably the most important element in understanding all of this. The Fed needed to have a zero interest rate policy in the wake of the global financial crisis because the transmission mechanism for its rate cuts and indeed monetary policy had been completely destroyed. There had been bank failures, there had been near bank failures, and as a result, there was a complete retrenchment in lending and credit growth. And the only way for the Fed to ignite the kind of economic rebound that it needed was to have interest rates at 0% for the longest period of time possible. And that was replicated by central banks all around the world. We're now in a different situation, and the perspective is entirely opposite as a result of the fact that transmission mechanisms actually remain incredibly healthy. US banks are the healthiest in the world. The broader economy is what's the issue at the moment. And of course, that's as a result of the COVID pandemic, the disruption in supply chains, and what we're seeing as a result of headwinds in China and Europe and indeed elsewhere. And that requires a very different strategy. So, I guess you could say it's horses for courses. In other words, what was required in 08 is very different from what is required today. But I do think you're right in that the stark difference in the way that we perceive these is definitely very interesting.
Martin, what is horses for courses?
It's a UK term about horse racing. In other words, if you have a muddy track, you're going to have a horse, with a stronger grip and a bit more power and thrust, who's going to perform well. Whereas you have a flat, dry track, you're going to look at a filly that's maybe a bit lighter and a bit sort of prancier. So if you're a betting man, these are the things that you want to decide. It depends. You don't make your bet on the horse until you understand the course.
It's not warm beer. I don't know if I got that phrase
Small
right either.
beer.
I'm still working on small beer. Pardon me. No, small. Listen. The
Warm
time
beer
will
is
come.
excellent.
You and I will go to the UK together to hang out, and I will get to use all this lingo that I've learned from you over these many months.
And we will have a small beer.
Yes, we will, and maybe a large one as well. I did ask you this last month ahead of the November meeting, I do believe. If you were in the room today and you got the first question or one of the first questions, what would you ask Chairman Powell?
Gosh, first question. Let me think of how I would best phrase it. I would say, Chairman Powell, we have had 5 consecutive months of decline for headline inflation. And the suggestion does appear that this is going to continue well into the first half, at least, of next year. Yet you have been signaling rate hikes not only into the start of next year, but you plan to hold them for the most of next year. Is that the right stance when the economy is weakening and inflation is slowing? Now, that's a poor question, I might add, because it's closed. You should always, of course, answer an open question and don't give him the opportunity to answer with yes or no. But that's kind of where I'd head.
Yes, yes. But to be fair, you've watched these press conferences. He doesn't tend to just give
No,
one-word
that's true.
answers. If he has an
That's true.
opportunity to sort of play the game a little bit, or essentially, I noticed that sometimes if there's something that he feels like he didn't mention, he'll use a kind of unrelated question to say, but to this other point, and then he kind of loops in something to, I guess, always keep people guessing. I call it like a Rorschach test, right? If you're looking for more dovish comments, he gives you things to make you think he's leading that direction. The same is true for the Hawks. I love a day like today because obviously here on the stock exchange floor, we talk about the Bulls and the Bears. And then in terms of monetary policy, we also got the Doves and the Hawks. I love our animal analogies here for the markets. What will you be looking to hear in order to set the stage for the February 1st FOMC meeting? It's going to be here before you know it.
Yes, there's no question about it. It's actually, thankfully, a decent gap between obviously what we're going to hear today and the next meeting in early February, because it will give us an opportunity to see a host of economic data points, jobs, inflation, the Fed's inflation gauge, ISM and PMI indices, and indeed all the rest of it. And maybe even also importantly, JD, we are also going to understand what other central banks are doing. It probably shouldn't escape our attention that tomorrow, both the Bank of England and the European Central Bank will make interest rate decisions, along with the Swiss National Bank. So it will be interesting to see whether or not there's a change in hawkish tone on the other side of the Atlantic and what influence, if any, that will have on the Fed's thinking going into next year. So to some degree, I think we will get an understanding of the Fed's thought process as it stands today and where they expect terminal rate to be in the early part of next year. But I don't think, paradoxically, that's going to give us a great deal of understanding as to what might happen in February, because I really do believe that there are so many pieces of data in between now and then, and a lot of market action to get through, including not only fourth quarter earnings, but first and second quarter earnings projections from the banking sector and from the tech sector prior to the Fed meeting. So there is so much activity between now and then. Even though we will get the broad strokes of where the Fed would like to go, they may not be able to finish that painting until they understand what all the dots are in between. To torture that analogy as further as I possibly can.
Yeah, no. Listen, it's any analogy you ever want to go with, I will hold the space for you, Martin. It's always well appreciated for context and perspective. Some early hopeful chatter that I've been reading says that the February rate hike may only be 25 basis points. Have you seen any early suggestion of what to expect there for 2023, and is that in line with what you've seen?
The last I saw, and this was a bit more than an hour ago, so lots could change, but it's probably about the same. I think it's about a 58 to 60% chance of a 25 basis point rate hike in February. So we may be at the tail end of these larger rate hikes. We're certainly over the 75 basis point discussion for certain. 50 is almost a lock today. But it does appear that the trajectory is going to change into those 25 basis point increments, both up and down, going forward. Again, barring some sort of unforeseen catastrophe. But yeah, I think it's about 60% chance of a 25 basis point rate hike in February is where we stand right now.
We saw inflation cool in the month of November with consumer prices rising at a slower pace than anticipated. We also saw a jump of 0.1% from last month. Are we nearing a point where this figure decreases month over month? What should we know here and take away from some of that data we got earlier in the week?
Yeah, I think it won't be long before we absolutely see decreases. We're still looking at cheaper gas prices on an annualized basis. That's going to have an impact on headline inflation going forward. Oil prices, if they don't react too funnily over the winter months, will probably elicit further declines, and as a result, that's going to ease pressures at the headline level of inflation. So I would imagine we will get negative month-on-month prints, potentially in December, but probably more likely in January as the measurement period gets a little bit easier. The one caveat to all that, JD, is that the labor market still remains incredibly tight. A little bit more than 10 million unfilled positions. And of course, we're seeing wage growth continue to deepen and embed itself into the broader economy as it just becomes more expensive to tease people out of either early retirement or indeed from staying at home or working hybrid or whatever the case might be. So it will be difficult to accelerate the decline, if I'm not being paradoxical in describing that, of inflation as a result of the tightness in the labor market. However, what we might see from earnings projections is companies beginning to scale back on hiring and indeed, unfortunately, executing some layoffs. That could cool the labor market a little bit and as a result help inflationary pressures. But the assumption is that by the end of next year, we're going to get, if not to 2%, certainly within about about 2.5% on headline inflation, according to many Wall Street projections. So we are simply going to be moving in that direction very quickly over the next 8 to 9 months, and as a result, that's arithmetically that's going to have to deliver negative month-on-month prints. So I do expect those to come reasonably soon, and as a result, we're going to get to that 2% target probably more quickly maybe than people had anticipated even only a couple of months ago.
Yeah, and at these press conferences or these meetings, these events from Jay Powell, we get reminded of the labor market. When he came out and took to the lectern in November before he did the Q&A, he sort of gives an overall view, a state of the economy. And I remember just a month ago, in his words, it says the labor market extremely hot, unemployment near a 50-year low. He said the labor market remains out of balance and demand exceeding supply of available workers. So how important is that part of it for him to come out and sort of set the stage as a reminder? It seems as if he almost takes into account all of the recent economic data, and he kind of wants to set the scene of expectation before he gets into the question and answer. We could probably expect something like that, an updated version of that this afternoon from him, right?
Absolutely. And I think you've actually sort of alluded to a point which is always worth considering when we look at the broader scope of interest rate decisions and their effect on the market. Ultimately, we tend to mistakenly see Fed activity in isolation as an intellectual exercise, if you will, as to where they would like to calibrate interest rates for the broader economy, and as a result, how that will filter into financial markets. But if the Fed rate decisions are predicated almost exactly to data that comes through from the real economy. So we're putting the cart before the horse to some degree. We are talking about Fed rates before we understand the data that should actually deliver them. So if we backtrack a bit and look at the data that predicates a particular Fed rate decision, we can probably have a better understanding. And I think that's why Chairman Powell is so insistent on reminding us about the tightness in the labor market and the pressures that it could bring to inflation readings. He's trying to sort of illustrate the fact that they are not making these decisions as a result of whims or forecasts or sort of expectations that aren't backed up by data. And the best way for him to do that is to constantly remind us that one of the biggest influences to headline inflation is prices. And of course, those prices can only be sustained as a result of people's ability to pay them. And that, of course, is sustained by increasing wage growth. And that wage growth will continue to accelerate if the job market remains as dislocated as it is at the moment, with so many unfilled positions and so much demand for labor and help.
Yeah, and of course, people continuing to spend, I mean, for more or less, at least in many parts of it, and you say whether or not they have the ability to, a bit of a different question. But I mean, listen, people coming out of the depths of the pandemic, their personal quality of life priorities have shifted. Where and how they're willing to spend money has shifted. It seems like a lot of this is just trying to play catch up to understand where we go from here. I do want to move on to the FTX drama because, again, this is a storyline we could spend all day talking about. Sam Bankman-Fried arrested, of course, in the Bahamas earlier on Monday. What else have we learned since? What a saga.
It really is. For me, JD, and I don't know if you had this experience yourself, but I tend to, I reflexively, I guess I should say, had a more human reaction to the images that I saw last night of Bankman-Fried being taken out of the courthouse in the Bahamas and sent to the detention center after he was denied bail as a result of the judge deeming him a flight risk. His lawyer had expressed the notion of a $250,000 bond, and he wanted Mr. Bankman-Fried in order to be able to sort of, work with him on his defense. But that was denied, and extradition processes are now ongoing. It's unknown at this point how significantly or to what degree Bankman-Fried and his lawyer will fight that extradition process. But to see that young man in handcuffs being escorted from the court, it looked incredibly downcast. He had, of course, been standing with his parents during the bail hearing, and there was certainly a modest emotional reaction from all of the family. when the verdict was delivered. It just reminds you that there are people in this story, as well as being a dramatic and interesting story for the rest of us as well. That's not to indicate in any way that I'm sympathetic to the charges that are laid against him, because they are serious, and there's an enormous amount of money missing, and there's a great deal of financial stress brought upon people who were promised things that were simply not delivered. But at the end of the day, I did have a human reaction to seeing that. I guess it's a reminder of how serious all of these allegations could be for this young man. JD, if he were to be convicted on all charges and the maximum sentence were to be applied, that's 115 years in prison. It's no longer a joke. It's no longer a laughing matter with respect to his constant media appearances and conversations on Twitter Spaces and social media messaging and everything else like that. Now it's real, and he is facing significant prison time. His colleagues are likely to be indicted as well, because you can't have a conspiracy with yourself, and conspiracy was a great portion of the charges that were brought by the U.S. Attorney's Office yesterday. There's going to be more people rounded up in this, and it's going to be expanded. And this is where it changes from something that we all snickered at to something that becomes very, very real.
Old-fashioned embezzlement. That was the word from the phrase from the new FTX CEO, John J. Ray, in the Financial Services House hearing yesterday. What else were some of the top highlights for you? It was pretty interesting to have this new CEO and essentially, in what appears to be full transparency, lay bare to just how bad he has since discovered things at FTX before he took over were.
Yeah, that phrase I think was really telling, because it tries to undercut the assumption that this was a great and sophisticated ruse, or indeed that it was such a sophisticated company that it was beyond the control of a young man or he and his colleagues or something of that nature. I think Bankman-Fried had tried to express the idea that the company just got too big too fast and was simply too complicated for him to manage, and that was the result as to why there was so much money missing and such a rapid collapse. John Ray essentially cut the legs out from under that argument, saying, listen, this was just old-fashioned embezzlement, as you just described. This was a case of taking customer deposits, essentially directing them almost immediately to the Alameda Research Hedge Fund. And then, of course, they were used to make risky bets into the market, to loan money against fictional and ultimately worthless cryptocurrencies, to buy luxury properties, to extend the kind of lifestyle that was enjoyed by this very tight group of people on an offshore island in the Caribbean Sea. So to some degree, it was telling. Mr. Ray put it in such stark terms, because that is such a contrast to the messaging that we have been seeing for a number of weeks now about simply it being too complicated a business to manage by one young person. Mr. Ray is saying, no, that's not the case. This was just out-and-out theft.
Incredible. We will have the Senate banking hearing slated for later today. Is your expectation in line to learn more of the same that we learned yesterday?
Probably not much more, I don't think, for my money, JD. I think we really did have an interesting insight into what was happening at the company. And really, furthermore, I think if you're a cynic, we had an interesting insight to the lack of understanding of the whole crypto space from the lawmakers that were questioning John Ray and who wanted to sink their teeth into Bankman-Fried himself. They lost that some relief from the lawmakers' perspective, because they can marshal the resources with a little less time pressure and actually come up with something that's a bit more collective and cohesive. But of course, one of the charges that can't be ignored in all this is the fact that the district attorney's office says that Mr. Bankman-Fried made illegal donations to politicians of all sorts in the United States. And of course, he was one of the biggest political donors on record in 2022. A lot of that is going to be clawed back, but there's going to be egg on the faces of lawmakers who actually ended up taking the money, who are now making the loudest noises about tightening the restrictions on this burgeoning industry, which we all agree is something they should have done many years ago.
Yeah, campaign finance is a absolutely terrible system that helps drive our democracy. Like in terms of just sitting there and, you know, when you have a real deep love for our republic and you love the history, you really sit there and say, man, we do things backwards. And campaign finance is one thing that we just need to hit the detonate button on, go back to square one, because this
Yep.
is the problem. If the very forces, the power brokers, are helping to elect the same people who are supposed to hold those same power brokers accountable, it's been this way for a very long time. Doesn't get any better. You can tell I get heated up about this. I pull out my hair because I love Congress. I love Congress, but I also really can't stand Congress at the same time. I've been saying that for years. Okay, time now for our rapid fire section. Whew, as I cool off, let's talk Delta. Fascinating story. Why are shares of the airline taking off, Martin?
Yeah, really big gain today. They have an investor presentation in New York, which they do essentially this time every year. But the upbeat tone heading into it really caught investors by surprise. Essentially, the regulations say, JD, that a company that's about to have an investor presentation has to make that information known to the wider market so as not to be accused of giving preferential treatment to the people that turn up or the analysts that they spend a lot of time with. It's basically part of something called Reg FD, Regulation for Fair Disclosure. Which is about 20 years old. But putting that aside, Delta has said, listen, profits next year as a result of this travel boom. And we see revenues rising between 15 to 20% of 2021 levels as a result. And that is really just excellent news with respect to the whole of the travel industry, which is enjoying this post-pandemic resurgence. The TSA said, as you'll remember, in the Sunday after Thanksgiving, they checked 2.6 million passengers. And that's the most since 2019, when the all-time high was 2.88 million. So we're very close to those pre-pandemic levels and probably going to exceed them. Jet fuel prices are falling. That's excellent news. Gasoline prices are falling, and that gives people a little bit of extra pocket money. Hybrid work hasn't disappeared, which gives people the flexibility to travel. So it really is a perfect storm, if you will, for the airline industry, and they're taking advantage of it. And that's why the stock is performing so well today.
Yeah, of course, gas is basically at a one-year low. It's about 1 cent lower than the national average. Still higher than we've had for recent years, but it's not the $5 a gallon we were paying on average back in June, for whatever that's worth. Okay, number two. Next up. This may be welcome news by many who have quickly not liked this man recently, but Elon Musk is no longer the world's wealthiest person. Who is it?
Yes, weep not for Elon Musk. I think his children will be well cared for nonetheless. But according to the Billionaires Index put forth by Bloomberg, he is not the world's richest man. It is a man named Bernard Arnault. He is 73 years old, and he is a Frenchman who is at the helm of the luxury goods group LVMH, brands that we all recognize, Dom Perignon, Tiffany, and others. He is a really interesting character. He maintains an incredibly quiet and low profile, even in the European circles. He's not one that's seen, sort of out and about in celebrity events and red carpets and all the rest of it, despite the fact that he is at the helm of essentially what is the biggest luxury brands group in the world. He actually began in property development and did some of it here in the United States, went back to France in the mid-1980s and began to put together these luxury group businesses and built LVMH as we know it today. Bloomberg estimates his personal worth at around 171 billion US dollars, around 10 to 11 of which is cash and near cash. So in other words, he's not just a paper billionaire whose fortunes are going to rise and fall as a result of stock prices, which many of the tech billionaires certainly are. This guy has developed wealth over a number of years, and as a result, sits across the top of that Bloomberg Billionaires Index. And I think we just pause for a second, JD, and reflect the idea or the concept of being worth $171 billion.
I mean, I'm only worth like 170, so 171 is, I get it. That's pretty cool, right?
You're sitting with a coffee cup on Wall Street hoping for pennies from passers-by, is that it?
That's literally what this is. You think this is green tea I'm drinking? No, it's so I can get some help here. It's an awesome show, obviously. Yeah, if anyone has it, folks, please. Listen, it's a really important day. I think for a day like today, we always try and drive home what monetary policy, what these top headlines mean for people watching. How does this impact you? And you are the best source to go to each and every morning here in our broadcast, Martin, for that context and needed perspective. Thank you. Enjoy the Fed later on today, and I can't wait to break it all down with you this time tomorrow. Martin, thank you.
We will do it tomorrow with glee. Thanks, mate.
You got it, brother. All right, thank you. And also horses for courses. So you learn something new every day. That's going to do it for the market open here from the floor of the New York Stock Exchange. Stick with the street for more on these and all of the major market stories that matter to you. We got Jay Powell at 2 and 2:30, and we will see you tomorrow.